It's on sale 60%. What do? You go inside and you buy because it's cheaper than what it usually is. Instead of costing 60 bucks, it's 50% down. It costs 30 bucks. Oh no, I don't want that. It's too low. I'm not going to buy a stock that it's down 50% because of a crash. I'm not going to buy McDonald's because it's down 50%. Of course I am, man. What the heck? What's up, you guys? Welcome back to the channel. Andre here. Today we're going to talk about how to get rich from the stock market. Now guys, I don't mean that you're going to get rich overnight. I'm talking about getting rich over time. See, there's a lot of people, especially like when I talk with my friends about the stock market, one of the biggest things that they tell me is like, ain't the stock market like a risk? I mean, Corona hit, the market dropped 30%, you lose all that money. It's like gambling, man. Why you doing that? That's not smart. Guys, if you want to get rich in 2 weeks from the stock market, don't invest your money, okay? Just go to a casino, bet on black or red, and do that instead. You're going to lose money either way, so you probably still have better chances in the market, but still, it's a bet, okay? It's definitely a bet. The stock market is not about getting rich really quick when you're talking about investing in the stock market. Trading, completely different business. We have videos on trading. This video is for the people that don't want to day trade. They just want to build a portfolio where they can make money over time. That's what we're going to talk about today. So one of the biggest failures that I see when people join the stock market is they will invest in companies that they feel are undervalued. Like they don't actually look into the company's numbers, but since like 2 years ago the company was worth 20 and now it's worth 2, people feel like it's a good investment. For example, let's check Hertz. You probably are seeing my computer. So is Hertz not listed anymore? Okay, so as you can see, back in 2014, Hertz was worth $91 per share. Okay, right now Hertz is worth $1 per share, $1.10. Is Hertz a good investment just because it's down so much? Like if this recoups all of this drop, you can make 8,000% on your money. Okay, is it a good investment? Probably not. Okay, probably not, because Hertz is in bankruptcy. Okay, so this is not a good stock to buy. There's a reason why it dropped so much. It wasn't like some type of like situation like where the market just dropped. No, the company it's down because it's not worth as much as it was before. Now, a good company to look into, for example, Amazon. See, Amazon is always growing. Look at this company. This is a company that you want to invest in. The biggest risk that you're getting into when you buy Amazon is you're gonna get rich over time. I'm not saying tomorrow. Okay, let's say that I made this video a couple of weeks ago and Amazon was at 3,300 or 3,400 and you bought thinking that you're going to get rich, and some weeks after you lost 7% of your money. Okay, I'm not talking in a pair of weeks, okay guys, I'm talking about years and years. Okay, this company, look at this, 1,700% since, when was this? 2012. Jesus Christ, okay? That's like 10 times your money. It's freaking insane. It's a good investment, okay? I'm not telling you to buy Amazon. What I'm telling you, look for these charts that go up like a little dragon. Look at this. It's just flying up, right? Apple, for example, one that comes to mind. Apple is currently down, if I'm not mistaken. Yes, it is, a little bit from the highs, right? It's a little bit down from the highs, quite a bit actually, almost 15%, but it's still a little dragon, right? A little Chinese dragon just going up in value. Tesla is down right now, but it's still a little, Chinese dragon going up in time. Now, Tesla is not as old and hasn't proven themselves like Amazon, okay? Amazon is a way bigger company than Tesla. I'm not telling you to invest in any of these companies. I'm telling you, don't invest in a company that is downtrending. Okay, invest in a company that is going to go up with time. Because if you invest in that, let's see Bank of America, I don't have Bank of America, but since I made fun of them like in the last thumbnail, Bank of America, back, exactly. Is this a good stock to buy? Maybe it's decent. They pay dividends, okay, 2.67%. So you have to account the dividends into this chart. But it's consolidating. It's not an amazing company, right? I mean, it's doing all right. I don't really bet on big banks. I probably have some shares of these on the S&P 500. I'll talk about that in a little bit. Let's look into another, for example, American Airlines. Decent company, but it has been downtrending since 2018. It dropped 50%. Guys, 50%, and then Corona hit and it basically went to shit. Now it's currently trading low, right, for its value, but we don't have flights. We have Corona, right? We can't fly. This thing is not going to go up probably unless we get an actual vaccine in where no one will get Corona again. It's probably not a good company to buy. McDonald's, okay? I don't really go to McDonald's a lot. I go maybe twice a year because I really like the hamburgers, but it's not very healthy, right? It makes that little dragon going up. Again, this crash was Corona, okay? Corona crash. Coca-Cola, same situation, right? Coca-Cola makes that little dragon going up, crash from Corona, and it's almost trading at pre-Corona levels. I think McDonald's is actually above pre-Corona levels. We can actually see. Yeah, so Corona was here, so it's trading at the pre-Corona levels. So it's probably a good investment to buy McDonald's because they only go up, guys. They only go up. There's a reason why Warren Buffett buys these companies, okay? It's because they only go up. For example, we can see Berkshire, which is Warren Buffett company. They have two different stocks, okay? Berkshire. Let's check out the B stock, okay? See, little dragon. It has been more stable since 18, so yeah, not amazing like McDonald's, but it's a decent stock, right? It's a decent stock. We can see the A version of these. It's probably the same pattern, exactly. Same little dragon just consolidating right now. Maybe we'll see a push after this, right? See, these are the type of companies that you want to invest. You don't want to invest in a company that has been down trading for years, okay? Just because it's low right now compared to what it was 5 years ago, it doesn't mean that it's going to recoup that lost value, right? There's probably a reason why it's trading lower. For example, this is a Portuguese company. They sell paper. You probably have heard of them. Navigator. Okay. Check this company out, right? 2018. It's down 56%. Is it a good company? Probably not, right? Probably not. They do pay dividends, so dividends is a good thing. Now, let's say you don't want to look into actual companies. There's a solution, okay? You can index your money. And this is the best thing you can do, actually. Okay, it's better than trying to find your own stocks unless you're really good at finding stocks like Warren Buffett. This is probably the best way to go. There's a ton of ETFs, there's a ton of indexes. There's a ton of indexes and there's a ton of ETFs that track these indexes. One of the indexes that are one of the biggest indexes is the S&P 500. You probably know of them. It tracks the 500 biggest American companies, okay? And inside there's 505, if I'm not mistaken, shares, because some companies like Berkshire Hathaway and Google and Facebook actually have two types of shares. Okay, so that's why there's 500. I believe there's 505, if I'm not mistaken. Okay, see, this basically follows the US economy. In this case, it's only the 500 biggest, so it goes up, little dragon pattern, and they pay dividends every once in a while, maybe 4 times a year, probably, right? For example, I do this, okay? In my case, I buy VUSA, which is another S&P 500, but it's listed on Amsterdam, so that means it's in euros. So it's better for me as an European, okay? They also pay dividends. If you don't want dividends, because dividends pay tax, okay? You get 15% if you're an American, and if you live in a socialist country like Portugal, for example, you pay those 15%, and then you pay the extra for the 28%, okay? So it's almost 30% tax. So you pay another 13% on top of that. So if you don't want to pay that, just buy an accumulation instead of it doesn't say here, I'll show you. Instead of a dividend or distributing ETF, you buy an accumulation ETF. and that way you don't have dividends. I like to have dividends because it's cash flow. I see the money coming in. I can spend that cash on new shares, so it's something that I like to have. Okay, so let's just check, for example, if you want to buy an ETF. All of them will have some sort of platform. VUSA is issued by Vanguard, which is a good company that has a lot of ETFs. I'm not telling you to buy the S&P 500. There are world ETFs, for example. They're safer. They will grow less, but they are safer. I think it's EWDA. Yeah, exactly. So this is a world ETF. See, instead of being the S&P 500, it's a world ETF. Again, same little pattern going up. You have a risk here, guys. You're gonna get rich. That's the biggest risk that you have when you buy these types of things. You're gonna get rich over time, not in 2 weeks. But if you're 20 and you leave these for 40 years, okay, you wanna take it at 60, or 45, you wanna take it at 65, you're probably going to be a millionaire, okay? We'll do that math in a while. So just go to the company that issues the ETF page and you can see a lot of information about the ETF, like what type of sectors are they invested in, because there's a ton of ETFs tracking, for example, the S&P 500, and each ETF will have a bigger position on different companies. Okay, this is just the one I buy. You're probably not going to buy the best one because they outperform each other in different years. So one of them is already a very good investment. Okay, you can actually see here they have like 34 pages of all of the shares they invest in. Apple, Microsoft, Amazon, Facebook A, Alphabet is Google, C and A, Berkshire B, Johnson & Johnson, Procter & Gamble, Nvidia, Visa, MasterCard. There's a ton of companies, okay? So by doing it this way, I just leverage, or I just hedge my portfolio, because I buy a bunch of things with just 50 bucks, 57 euros, right? I buy a bunch of companies. So even if one goes down a ton, nothing wrong, because I have another 499 companies. And if one goes down enough that it actually gets thrown off the S&P 500, another will come in to fill that void, right? So it's a good thing to invest your money on ETFs, because you will never go into zero. On S&P 500 index ETFs, okay? Because you're not going to go to zero, because if the 500 companies that are listed in this ETF go to zero, or in this index go to zero, there's another 500 that are going to fill that void. So you can drop a little bit, okay? Your money can drop a little bit, but it's not going to zero, right? Because there are still companies supporting that index. That's why indexes are like the best way to invest in over time for most people, okay? 15% after, like, let's say that I make 10K a month. I'm not going to tell you how much I make, but let's say I make 10K a month. I pay my rent and I pay my food, and of that, I take 15% and I throw into VUSA every month. Okay, that's what I do. And when I'm 65, I will retire with $1 million more. Okay, I'm saying a millionaire, not $1 million, a millionaire. We can actually go to a calculator. Let's say that you throw 400 bucks every month into an S&P 500. You have an interest rate average of like 7%. Again, guys, this is average. You will have negative years where the S&P 500 drops, but you will have extremely positive years. So an average, and that's why you have to do this for years and not, buy today to sell tomorrow, okay? In average, 7%. So let's say 45 years. You're 20 right now. You want to take your account out when you're 65, 45 years. Compound monthly, okay? You buy every month, okay? Monthly transactions, 400 bucks, okay? And this basically doesn't change anything. Let's calculate. Let's see the projections. So the total deposits, okay, of 400 bucks a month will be $216,000, which is not a lot of money. But look at your balance, right? 1,500,000. Like, you use 260 bucks to make 1,500,000. Now, this seems like insane, guys, but this is like the power of compound of interest, okay? Because you're investing not just the 400, but the profits from the 400 will be invested again. The dividends will be invested again. So you're growing exponentially your account. You can actually see it's an exponential growth, right? It's freaking amazing. It's what it is. And this is the biggest risk you have when you invest in these types of things. Guys, if you want to buy one single company, I know a lot of people that are throwing their life savings into NIO. I do believe that NIO is a good company, but they haven't proven themselves. Just because they have a good chart right now, look at this. This chart is freaking, well, I'm still sad that I sold at 21. But look at this drop that it had the other day. 15%, right? They started in 18, guys. This is not proving themselves. Even though they're up a ton, what will happen in 2 years? You don't know, okay? They haven't proven themselves. Okay, so maybe save 5% of your investments to these types of companies, like riskier companies. And then the rest, you put on an index. You put into companies that have proven themselves. McDonald's. Jesus, what am I doing? MCD, yeah. Little dragon pattern, okay? Chinese dragon. I know some people don't like the Chinese. I love the Chinese because they work for cheap, but still, Chinese dragon, okay? This is the pattern that you want to invest in. And if you don't want to pick individual stocks, go with the World ETF or the S&P 500, okay? Sorry, the World Index or the S&P 500, which is also an index. An ETF is just a way that you can invest into this index, because you can't actually buy an index, okay? An index is just an index. So you have to buy an ETF that tracks this index. And the cool thing about the ETFs is since they're like software managed, you basically almost don't pay. Like the cost is 0.07% to hold these. It's extremely cheap. If you go into a mutual fund, it's probably going to be like 5% just to enter, right? Here it's not, okay? It's this year. So it's very low management cost. And this is how you get rich from the stock market, guys. Okay? You buy proven stocks, okay? Stocks that have proven themselves. You don't want to find stocks? Get a freaking index. This is my retirement plan, by the way. Like, my full retirement plan is this. I do have houses for sure, but I don't know if I'm going to sell them in the meanwhile. This thing, I'm 100% sure that I'm not going to sell. When I'm 65, if I need it, I'll call my broker and I'll say, liquidate everything. Oh, and if there's a big crisis in that year, I will wait like 1 or 2 years just to get it back to that position. Because when there's a crisis, some sort of crash, okay, let's see the SPY again, or even the World ETF, it crashes, right? 30% down. But guess what? It hasn't been a full year yet, 230 days, and it's almost already at the same level. So if you wait 2 years, you will have your money back, even after a crash, okay? One of the worst things that you can do is sell a red candle, okay? You look, the market is down 30%, I don't know, man, I better sell. No, don't do that, okay? Worst case scenario, you buy more. You don't sell on a crash. That's the dumbest thing you can do. That's how you lose money. That's why so many people lose money, because they see a red day and they sell. You don't want to sell when it's low. You want to buy when it's low. When you go to a store, you want to buy some clothes, for example. You want to buy Adidas, which I really like. You don't go, like if you see it's on sale 60%, what do? You go inside and you buy, because it's cheaper than what it usually is. Instead of costing $60, it's 50% down. It costs $30. Oh no, I don't want that. It's too low. I'm not going to buy a stock that it's down 50% because of a crash. I'm not going to buy McDonald's because it's down 50%. Of course I am, man. What the heck? For sure, McDonald's is one of the biggest real estate companies in the world. A lot of people seem to think that McDonald's business is hamburgers. Nah. McDonald's business is real estate. They have the best real estate in the world. Go outside if you live in a city that has maybe 2 McDonald's at least. See the locations of their real estate. See the real estate they own. They're a freaking real estate company. And they're amazing, okay? They do sell hamburgers. And the hamburgers are decent, okay? But they're a real estate company. Not a lot of people think about this, but McDonald's is a real estate company. They have the best real estate in the city. They have the best corner buildings. They want a lot of glass, people looking in. They have, like, if they were to sell their real estate, Jesus Christ, I think that thing alone is worth a ton of money. Not just the hamburgers. Like, they don't even need the hamburgers. They have the best real estate, right? So if the stock is going to drop 50%, you think I'm not buying real estate at 50% discount? Bruh, yeah, I'm gonna buy. Okay. You think I didn't buy McDonald's right here? Yeah, I bought. Okay. Yeah, I bought. I'm up what? It was like around here. So 56% on my money. Ha! Bruh. I'm nerding out a little bit, but guys, you're gonna sell when it's red? No, you're gonna buy, okay? If Nike is making a promotion on their latest shoes, you're gonna get inside and you're gonna buy, right? If you like Nikes, or Adidas, or Samsung. You think that if Samsung, like, when they dropped this phone and it was 50%, I was gonna say, nah, better wait that it's full price. I don't wanna buy when it's 50%. Guys, come on, okay? It's low, buy, okay? And the type of thing about these types of companies, they only go up. Stocks only go up. I know that's a meme, but the right stocks do only go up. And when it crashes, just buy more, okay? Like, again, it's not going to be a week or a month. It's going to be 10 years. Where do you see this stock in 10 years? It's probably going to double. I would say that. Maybe not double, but it's probably going to go up like a lot. In 10 years, McDonald's at 300 seems pretty doable in my opinion, right? In 10 years, I would say so. But again, I'm not telling you what to buy. You're better off just index your money. Buy SPY or I buy this one, okay, VUSA. There's an accumulation one if you don't like dividends because they pay taxes. Buy that one instead. Man, I had to record this video twice because I realized that I wasn't recording my screen and now I don't have a voice. Jesus. Hopefully you guys enjoyed this, guys. The risk is not buying, okay? Because the risk is you're going to get rich. I mean, investing 200 to make 15, yes, it's in a course of 45 years, but still, okay? You invest 200,000 to have 1.5 million. Who would not do this? That's the question. The risk is not to invest. The risk is you're going to get rich over time, okay? I don't make anything from this video, okay? I don't have ads in this video. I'm not selling anything in. I do have like some affiliate programs in the description, but they're not related to this video at all. I don't make anything from this video. So, yeah, let's see. Hopefully you guys enjoyed. Make sure you drop a thumbs up and I'll see you guys in the next one. Peace.